Welcome to Real Vision's Trade Ideas. Today we're sitting down with Jeff Meyers of Cobia Capital. It is great to have you here.
Thank you.
So this is your first time on Real Vision's Trade Ideas, and we actually found out about you through SumZero, which is a buy-side idea generation platform. And you were ranked #1 on that site for the ideas that you had posted there. Could you give us a little bit of your background, what you do, and your work with SumZero?
I decided to start my own fund in '08, or late '07, I guess. I got seed from my former employer at Siegler Colliery, $10 million seed, and launched January '08. Obviously a great time to launch a hedge fund. Not a lot of volatility that year.
Yeah.
But the truth is, it ended up being a good time to start because at the end of the year, there were, the bargains were ridiculous. I mean, there were things trading for cash, below cash. So we just scooped up, lots of companies at the end of the year, beginning of '09, and then '09, you had a big rally, and we took advantage of that. Had a great year in '09. And since then, I've been, managing the fund.
And you're mostly looking at stocks that other analysts aren't looking at, so you don't have huge mutual funds or large funds that are investing in these stocks.
Exactly.
Okay.
The small cap area is, because of size and liquidity, the big mutual funds can't invest there. And we also have something a little special, I guess, because we are, as I sort of maybe indicated earlier, we're still a value-oriented strategy. So a lot of guys in technology are not value guys; they're growth guys, momentum guys, et cetera. So we're looking at different names than they're looking at, or we're looking at names earlier than they're looking at them. So we get a lot of interesting opportunities, where we have very few other competitors, I guess, looking at them.
So how do you come up with your ideas?
So there's a lot of screening involved because we're value oriented. We probably get 70% of our names through screening, and we have about 65 different screens that we use to kind of parse the universe and try to figure out what's inexpensive, and then we dig in to those names. So that's the main way.
All right, so what trade are you looking at today?
So we're looking at a company called XLMedia. Ticker is XLM.LN. It's traded in London. Probably the cheapest stock you're going to see in a long time. Stock trades at 3 times EBITDA. So basically, enterprise value to EBITDA is about 3 times. So the way I think about that is, if you bought the whole company at that valuation, you get paid back in 3 years. So it's very inexpensive. I mean, EBITDA multiples usually range, 6 to 15 or so. So the reason is that, they've had a tough time the last couple of years. Let me explain the business. So it's called an affiliate marketer. So what they do is they get customers or clients, I guess, from the internet, and they pass them along to your site. So we think it's a very transferable skill. They started in the online gambling universe. So they get customers for, Unibet, 888, Betfair, guys like that.
And do they own their own websites, or do they own part of the gambling websites? How does that work?
So they have 2 ways really of getting customers. One is they have their own websites. So they have about 2,600 different websites they developed over time. And somebody will come, let's say somebody was interested in sports betting, in the UK, so they go to one of their sports betting sites. There's a lot of information about, different teams and odds and things like that. But then in addition, there are, little, say ads on the site for, $10 discount at Betfair, $10 discount at, Unibet. So if somebody clicks on that and they go to, let's say, the Unibet site, any revenue that they generate on Unibet, XLM gets half. Okay. So it's a good arrangement. It's sort of recurring revenue over time as long as the customer stays on Unibet. People, I think, perceive it as somewhat of a shady business. It's gambling. But what they do is they try to stay in regulated markets. So like the UK, for example, there's like a tax on online betting. So the government's getting money, they're incentivized not to shut things down.
So they're not completely operating in a gray area.
Correct. I'd say probably 70% of the markets are already regulated, and the other 30% are moving towards regulation. So now there are, like, for example, in the UK over the last year, the regulators have cracked down a little bit on having kids kind of basically under 18 get into gambling, and so they've cracked down on the types of advertising there can be.
And that's affected
XLM. Their big customers have gotten a little more conservative, until the regulation pans out and they can see, get a better view of what the regulation is going to be. We feel that's sort of behind at this point, so that was really over the last 2 years. And there is some more, like Sweden is regulating now, so the tax there is going to hurt some of the guys for a little while. So that's one way they get their business is the websites, 2,600 websites, people go to them, they eventually go to their, the customers, and that's how they generate revenue. The other way was through media campaigns. So they would have advertisements on other people's websites. So that was a pretty fast-growing revenue stream for them, but not a very profitable one. So what's happened over the last 2 years, they've really pulled back the media side of the business. So that's hurt revenue. Like revenue was down 18% last year on that. But EBITDA was only down 2% because most of the EBITDA is being generated by the other, by the publishing business. And the publishing business has grown, mid-single digits the last 2 years, so it's still growing. So we think that there's a lot of opportunity ahead of them now. There is, the U.S. basically said, at least on a federal level, sports betting is okay. So now each state has to come in and basically allow sports betting, and so that process is sort of ongoing now, and over time that's going to become a bigger and bigger market for them. And there are some, I don't even remember the number. It's some $20 billion amount of illegal sports betting in the U.S. So as that gets regulated, and those big customers, the casinos, want help gathering clients, then they'll bring in guys like XLM.
So that could be a big opportunity for them going
Yeah.
forward. So then, is this the biggest aspect of their business? You have the sports betting, you have the gambling aspect, you have the publishing aspect. Are there other areas that they're involved in?
Yeah, so they basically diversified a lot since they went public. When they went public, they were really a Swedish gambling company. Now they've diversified into other geographies, at least certainly within Europe, and now looking at the U.S. and Latin America as well. And they've also diversified their base of business, so now they're 30% consumer finance. So basically, and it's in the U.S. and Canada, and it's sites where they talk about, you go to the site and it tells you about different credit cards, which ones have the best points, which ones are good for younger kind of users, and then they have links on those sites to the credit card companies, and they get a revenue share from the credit card companies. So that's a growing part of their business. And, as I said at the beginning, like, it's a very, everybody wants customers, online customers, and they can gather them because of, their expertise in doing this. We've worked with them on, trying to discern like how tough it is, to start one of these, these sites that they have. And it's very hard to get ranked on Google, which is the key aspect of it. You have to have a lot of good content on there. You have to have a lot of good traffic on there. You have to have a lot of good links on there. And it takes 3 to 4 years to develop, sites. So, for example, in the U.S., they're not generating a lot of revenue now because these sites are still
coming up
in formation. But that's something that is not easy to copy. So.
Now, over the past few years, there was a pretty big run up in the stock. I think it was trading at 200 pence, and then it recently sold off down to 40 pence, I believe.
Yeah,
Could you talk about that as well as where you see the stock going?
sure. So basically, the run was, they were growing 25% plus, combination of publishing, which was growing pretty fast, and the media business, which was also growing pretty fast. And, profitability was growing as well. And they did that for 4 or 5 years. So when it first started, nobody knew about the name, and that's when we kind of came in because we saw this thing growing. We liked the business model, but nobody cared about it. So we got involved. It went from, as you said, it went from 40 to 200 pence, and unfortunately, we didn't get out of that much at 200 pence because the valuation was still pretty reasonable. And then they ran into a couple, issues with the media business, so they pulled that back. And then, the regulation in the UK hurt them, so that hurt the publishing side of the business. So they had 2 profit warnings, and that, took the stock down from 200 to 40. So we had some at, 40, 42, that level. The stock kind of stayed down there for a while. They had a trading update, which was, they said trading's in line, and the stock started to move, upwards, kind of slowly. Then they had, more recently, trading update and also a tender offer that they announced when the stock was at 70, basically. So the trading update was, again, things are in line for the year. Tender offer was they were going to tender for 10% of the stock at 80 pence. So the stock basically went from 70 to 80, and actually went above 80 for a little bit, like 82. And then most recently, I guess, they announced a succession of the CEO. So the former CEO was the founder of the company. He'd been on for 10 years. So he basically wanted to step back, and they found a guy he was more big picture kind of oriented, and they found a guy who was more detail oriented, very with good background, and so he's now taking over. But the stock took a hit on that, so now it's trading at 72. So it's actually an interesting arbitrage opportunity. You could buy here. You could buy 300,000 shares at 72 and tender them and get 80 for them.
When is the tender offer going to happen?
You have to tender by the 9th, I believe.
Of October or September?
No, of August.
Of August.
So it's
Okay. Very soon.
It's a very near term.
Okay.
Yeah.
Oh, okay. But nice little opportunity there. So with the tender offer, why would the company buy back shares at 80 pence on August 9th rather than simply buying them back now at a lower price?
Right. So they had been buying back stock previously, but they just, liquidity-wise, they just weren't getting enough shares in the market, so they decided to do it all in one kind of big fell swoop. I think they also think that 80 is still pretty inexpensive relative to the value of the company. And also the last reason is, there could be sellers in the name. They just want to get them out already. So I think that's, those reasons are.
So then, bigger picture, where do you see the stock going?
So we see it going, at least 120. So I said, I guess at the beginning, enterprise value EBITDA is trading at 3 times now. Probably 6 times is reasonable. And they have like $40 million of cash, so it's not, it doesn't actually double the stock price, but it gets you significant amount higher than where it is today.
And over what time horizon do you see it reaching 120?
Over the next year.
And do you have a stop loss on this trade, or is there a point at which something would happen and you would back out?
So we don't have formal stop losses. As sort of a value fund, we're probably more likely to add to something if it
On a pullback?
On a pullback, depending on a few things, depending on if the thesis still makes sense. And then the second thing is if there's a catalyst. We don't generally add unless there's an upcoming, earnings announcement or something we think is going to be able to move the stock.
Do you see a catalyst now? I mean, so I know you've been invested in this company for over a year. For how long?
3 years, 4
3 years. Okay. So is there a catalyst that you would see bringing it from 70 to 120?
Yeah, increasing penetration of the U.S. market in sports betting and increasing penetration of Latin America. Like Brazil and Argentina are now starting to, there's sort of online gambling presence there. That's a totally new market for them.
What would you say is the biggest potential risk to this trade? Is it simply the sports betting aspect and waiting for regulations to come on?
Yeah, it's a bad regulation. In one of the bigger markets, if somebody, if the regulators come in and say either shut things down or impose some huge tax, that's something that could hurt them.
Given that we've seen a recent sell-off in the stock, could you give us a perspective from the other side? What is the bear case for the stock right now?
Well, I think people look at it and say, oh, this is affiliated with online gambling, and that's like a vice, and nothing good's going to happen to them. That's kind of the prevalent thought of people who don't know it that well. People who know it better would say the risk is in regulation, like do these companies regulate in a kind of normal way, in a traditional way that other companies have regulated in, or do they come in with some ridiculous tax which is really going to shut things down or totally ban it? We think that the problem with all these other with markets where it's not regulated is it's the black market. People gamble on sites they're not paying any taxes on. It's totally unregulated, and you have kids gambling and addicted people gambling, and so that's why countries regulate, so they do have some sort of control over what's going on. And if they regulate it in sort of a logical way, they're going to get tax dollars out of it, and they'll be able to control kind of the experience for people.
And
so that's
clarity.
been the general experience of countries that have regulated. But there's always a chance, that a country will do something crazy, and that'll, block guys like XLM from the market. So, and that's why they diversified. They originally were like one country, one, business model, franchise, and now they're in the consumer finance aspect of things, and they're in a bunch of companies in Europe, and they're getting into the U.S. and they're getting into Latin America. So it's more, more diversified and should be, more attractive to investors.
All right, can you break down your trade in 30 seconds?
XLM, it's extremely cheap. The publishing part of the business has been growing, 5% a year the last 2 years, when, the media section of the business has broken down. But since it wasn't that profitable, EBITDA has stayed pretty much the same. And we expect publishing to start growing again pretty nicely next year. EBITDA should start growing next year. And once there's stability, the stock's going to go up.
And you see it going up to 120?
At least, yeah.
Great. Jeff, thank you so much for breaking this all down for us.
Thank you.
So Jeff is bullish on XLMedia, ticker symbol XLM.LN. He believes the stock is incredibly cheap and sees changing regulation in the US and Latin America as an opportunity for earnings growth. He believes the stock could trade as high as 120 pence over the next 12 months. Just remember, this is a trade idea and not investment advice. You should do your own research, consider your risk tolerance, and invest accordingly. For Real Vision, I'm Justine Underhill.